Welcome. Give us a couple of seconds and let everybody get admitted. All right. Welcome again to the Small Business Town Hall. Today we're going to be talking about the ramifications of taking the PPP funds. My name is Jason Knight, and I work with Exit Advisors, who sponsors these town halls each week. We have a couple of speakers today. If you would, as you're joining, you're going to be muted. If you would turn off your video as you join, and we'll have the chat feature open. So if you have questions, we'd love to have you submit your questions to the chat, and we will be taking those on as a Q&A at the end of it. So we're going to have a presentation from a couple of folks, and at the end of that, we will have an open Q&A to answer your questions that you submitted either through the registration process or through the chat as we go. So again, welcome. This is a weekly town hall that we've been hosting really to help business owners get a handle on the PPP and other challenges as it relates to the COVID virus and what we're dealing with right now. As we can come out of this, we may continue on with these sessions. It really, as long as they're adding value, we're willing to do it. So again, my name is Jason Knight with Exit Advisors. Exit Advisors is a group of consultants, business experts, professionals, and we work with companies to help them identify strategic direction, work with them on planning and tax estate planning, things like valuation strategies. And when the time is right, we will work with you to maximize your value, to work with you through a sale process and represent you throughout that whole cycle. And so from kind of start to finish, from getting a strategy built to help you build the value, to help you manage your taxes in your estate, all the way through the transaction itself, we're here to help. So again, as always, welcome. Today's topic again is the ramifications of taking the PPP funds. We've got a couple of speakers. Jevaughn Sterling is a Senior Vice President and Regional Commercial Banking Manager for Amegy Bank. And Jevaughn is going to give you just a little bit of insight from a banker's perspective on the PPP and the funding. He's worked with a lot of companies to obtain their PPP funding and is working with companies to make sure that their funding is forgiven and maximizing that process. And so he can give you some insight into what that might look like. And then we've got Gary Cooper from Cooper CPA. Cooper CPA, by the way, is a really well run, solid company organization that is working with small, medium businesses in areas of tax planning and as it relates to PPP and helping make sure that your accounting is in alignment with the requirements that you're going to need for forgiveness and maximizing that. So if you haven't worked with them in the past, you don't know Gary and his team over at Cooper CPA, highly recommend you speak with them. So Gary will be talking about that forgiveness process and the implications of taking the funding and where to go from there. And so we look forward to that. So with that said, Jevaughn, I'm going to give you a chance to introduce yourself, and I believe you're unmuted. So go ahead. Hold on 1 second. It's not unmuting you. 1 second. Yeah, Casey or Andrew, I'm not sure if you're able to unmute him.
I'm trying. I'm not successful yet, Jason.
So Jevaughn, you might have to unmute yourself. Let's see. Gary, how about you? Are you unmuted?
Let's see. I can.
You are, yeah.
I'm unmuted and there's my video. So
I'll tell you what. Gary, why don't we start with your presentation, and Jevaughn, we're gonna put you on the tail end of this as we work through the technical issue there, and so that we can keep it rolling. All right. All right. So Gary,
Sure. Okay. Thank you for coming today. This is an all-important topic. It's something that I think everybody's a little bit concerned with, keeping you up at night, wondering, is this going to be a grant or am I going to be faced with paying a loan back over really it's 2 years, but the first 6 months are going to be deferred and then you'll have 18 months to pay it back. So that could be very difficult for a small business, obviously, that has tight cash flow anyway, to look at an amortization period of 18 months. So my job here is to talk about, what it looks like, what does the requirements look like, how do we keep our books and records, and how do we assure ourselves if we've met all the requirements that this becomes a grant versus having a loan on your books. So if we can go to the first slide, that would be great. Whoever's switching slides for me. So we'll talk about this 8-month period. Once your PPP loans hit your account, that starts this 8-month period, 8-week period, race. To be assured of the maximum forgiveness, basically plan to spend 100% of those funds in this 8-week period on your payroll, lease payments, utilities, mortgage payments. The CARES Act completes forgiveness. You got total forgiveness based on the utilization of the funds. And so what I've gathered from Jevaughn and other bankers, this is going to be somewhat of a prescribed form that's going to be received from the SBA. So it's going to be something that's somewhat quantified. Okay, there's not going to be a lot of subjectivity into it. At least that's what we think today. The problem with this presentation and all the presentations that we've given, this can be somewhat of a moving target. So they are changing their mind as they go through this process of what is and what isn't. For instance, the EIDL loan, where at first they said you're going to get $10,000 and that's that. And then they came out and said, no, you're getting $1,000 per employee, up to $10,000. So we got to be expected that some things could change as we go along. We're just going to have to embrace what they've given us right now. I think what's really, really important, I'll just kind of cover this from an overview standpoint, keep good, sound records, okay? We're even recommending some companies, maybe you set up a separate account. I'm not sure that's going to be totally necessary. If you've got good books and records, you can isolate how you're spending this money. And when it comes down to the end, down to the 8-week period, when you have to fill out this prescribed form, you got good records to do so. You can prove up the fact that you've met what they call the 75% test and then the head count test. Then you can identify, the utilities, the rent, and the mortgage payments within the 8-week period. You can't go out and prepay a bunch of rent. You can't go out and prepay a bunch of other items. This 8-week period is going to be treated as if you're keeping your books using generally accepted accounting principles. So, you've got costs and you've got expired costs. This is expired costs as actual expenses for that period of time. So again, you should be focused on these 2 rules that we'll talk about. So go to the next slide, please. So let's talk about what we're dealing with FTEs, which is full-time equivalents. So this is the computation that you make to ascertain if you meet the 75% test. Now, what is the 75% test? All right, so that means that over this 8-week period, you're going to keep the same payroll level as you kept for a couple of periods of time that I've got down called the baseline periods. So your baseline periods is 2/15/19 to 6/30/19, or 1/1/20 through 2/29/20, the smaller of the two. And so what it comes down to is you got to maintain 75% of that pay level. So just in a real simple world, let's say that you keep all of your employees, and let's say that you cut the amount of pay that they receive by 25%. And in a perfect world, that's a pretty simple computation, all right? You've hit the 75% of total payroll. So under those circumstances, you're going to be able to have total forgiveness. But then you've also got, in line with that, we're going to talk about in just a second, the head counts as well. So, making sure that, and then you look at the equivalents on the screen. If you look at the computations, it can get a little bit more difficult if you have hourly employees. So then it's going to be based on hours. So you look at my computations on the screen. I mean, you got, 3 employees at 40 hours. You got 2 employees at 20, 4 at 10. Then you go make a computation, basically a full-time equivalence, to see if you meet the test with the equivalent number of people. So it's really interesting. And once again, I believe this form that you're going to have to prepare for the bank, with hopefully no subjectivity, is going to merely provide these computations. Okay, go to the next slide, please. Next slide. Okay. I'm sorry, go back to the salary and wage reduction. There you go. So, looking at the wages, you've got to also focus on the below 100 people. And what that means is anybody who's making over 100,000, you've got limitations with that. So to calculate this, you need to identify all employees during the 8-week period whom you employed at the point during 2019 and who did not receive more than $100,000. All right. So if you look at this, you're saying, okay, I've got, X number of employees. We talked about the head count. Now we're talking about the 75% where you're meeting the actual total payroll. And, basically, there's been some provisions in this thing where they've talked about, okay, what do we do if we get down to June 15th and we're not at 75%? I've cut some salaries, I've cut some people, I need to hit this milestone. Well, I mean, there can be where you provide bonuses for some of the employees to get you up to that 75%. Now keep in mind, again, the 2 tests, the 75% and the head count. So we're going to talk about that briefly right now. So you give some bonuses and you get up to the 75% of the total payroll with those 2 benchmark periods, then you're going to be safe there. Now, Jevaughn and I talked a little bit about the possibility with family members. And this is something we don't know yet. This just is speculation, right? So, there could be a possibility. Everybody thinks, oh, well, I'll just add my 2 kids and my wife to the payroll and I'll pay them. And then I'm going to hit the head count. And I'm also going to hit the 75%. There could be some family aggregation rules to where they look at that and the family could be considered one person. And then you could also get hit with the $100,000 rule. So be real cautious of that, thinking that you can add a bunch of family members on and hit those tests. And so there with the 75%, you can meet that total wages through some bonuses. So you do have some flexibility, but then they kick in, obviously, with the head count. So the head count is something that if you get your head count back up to what it was during those 2 benchmark periods before June 30th, then you can meet the head count test. So as you can see, you hit both of these. You report this to the bank. This loan will then become a grant, all right? Which obviously that's what everybody wants. Everybody wants the grant as opposed to the loan. And looking at the definitions, go to the next slide. Okay, so, I think we've talked about these over and over again. So obviously payroll costs, all wages, salaries, commissions, tips, severance pay, and so forth. But subtract any portion of employees who exceed $100,000 annualized. That's how you get the payroll cost. The rent, rent obligated under leasing arrangements. This includes both equipment and your facility rent. And keep in mind, as I just discussed, this is for the 8-week period. So you can't get down to, June 15th and say, okay, I'm going to pay 4 months of rent. That's not going to work. You can't go in and say, I'll pay my utilities for the next 20 years. It's like I said, it's on the accrual basis of accounting. Go to the next slide, please. Okay, so utilities, once again, payments for service for distribution of electricity, gas, water, transportation, telephone, internet access would all be covered under the utility definition. Then mortgage, interest, basically, for the 8-week period as well, and will be covered as well in that calculation. And keep in mind, it'll be a calculation as well. Next slide, please. All right, so let's talk about business realities, because this is really important. We've got some industries out there that they're going to have a difficult time hitting these rules. A couple of them, I've got some restaurant clients, and there's some difficulty there because some of these people are making more money receiving unemployment, and they don't want to come back. Also, obviously, restaurants right now are running at 25%, so they don't need all the employees. And there's going to be other industries like that too. Someone told me about the security industry is the same way. So what you got to keep in mind is the business realities. You're focused on the long-term health of your company, and obviously you want to meet these guidelines. You want it to be a grant. Worst case scenario, you got a 2-year loan at 1%. And then I've talked to Jevaughn, and he'll emphasize some of this as well. Working with your banker is so important. He's going to talk about that because, realistically, let's say you've gone through this period of time and your business has really suffered and you hadn't been able to maintain your payroll. You haven't been able to maintain some things. They've got, the disaster loan program, the EIDL program that, there's a possibility you could convert over to that with your loan, and it's up to a 30-year payout. So there could end up being some flexibility with this. But, once again, the CARES Act, we received this money to use it to bring our business up to good health and good standards and maintain our employees. So, what it comes down to is you didn't get this extra money to go out and buy a new beach house or buy a boat, go invest in the stock market. If you pull those shenanigans, then obviously it's going to be a loan. And, there's been some other information that has come out, where people have signed, their forms to get the loan that, basically if you don't need these funds, if there's other funds you could have had available, you need to give them back. I'm not sure. I think, Jevaughn will talk about that as well, about those provisions once he talks from a banker standpoint, what that means. And I think it's really important for everyone to understand that. Go to the next slide, please. Okay, tax provisions. Everybody's really interested in this. What is this going to become? Is it going to be forgiveness of debt? Well, I think what the IRS has done, they've got this notice 2020-32 that just came out. Now, yeah, they're not calling this the forgiveness of debt, but in substance, what the rule says right now, it is basically a forgiveness of debt. So how this works, I'll use debit and credits with you right now, try to paint a picture. Okay, so let's say you get your funds, right? What did you do in your general ledger? You debited cash and you credited the loan. So that's the way it sits on your books right now. And as I said earlier, keeping track of how you spend this money is so very vital. Talking to your banker, maintaining that relationship is so, so critical. And so then you get down to the 8-week period. Let's say you met all the requirements, you met all the headcount rules, you met all the 75% rule, utilities, all the stuff that you're supposed to be utilizing these funds for. Now, what do you do? What's your entry? Well, what the IRS is saying is this, is that however those funds were used, those particular expenses are not tax deductible, right? So what does that mean from an entry standpoint? That means what you do now is you debit the loan to take it off your books, and you credit salaries, wages, utilities, leases, what have you. So what does that mean? Well, a pig is a pig no matter how you dress it. So, realistically, that's forgiveness of debt, because you're not able to have those expenses taken for the year. So let's say that your revenues stayed flat, all right? And you have less expenses, obviously, so you're going to have a larger bottom line. So, this is another reason why tax planning through this whole process. We had 2 weeks ago, we talked about the tax implications of COVID-19. And so this is just another reason why you probably ought to get with your CPA and take a look under the hood, see what the tax ramifications are going to be with this, and start planning on having to pay extra taxes. And of course, estimated tax payments, the first one is July 15th. Then you're going to have September and January that you're going to need to pay these taxes. Next slide, please. So what's next? All right. So with this, what I just talked about, Congress is still working on this. And what we hope is obviously that's not going to be the case. They shift on this and say, okay, these PPP funds, if they're a grant, then basically they're going to flow through M1 on your Schedule L with your tax return, and there would be no tax considerations whatsoever. But I'll be honest with you, just from a CPA's perspective and looking at this, I don't think that's going to be the case. I really think that what's going to happen is it's going to end up being taxable income. Okay, next slide, please. Okay, so recommendations. So all right, we've talked about this. I'll just reiterate it a little bit. Maintain organized records. Most of you have a double entry system. You have an accounting system. Just make sure you isolate these expenses, and that when you get down to the 8-week period, that it's going to be really easy for you and your banker to meet, and you fill out that form, submit it, and be able to consider this a grant. With that, you should create a plan right now. Don't wait until the end of the 8-week period. I have this all the time with taxes. People just really, really don't. They don't plan. They wait down. Hey, it's April 10th, Gary. I'm here. So let's get it done. And so just plan and make sure you're organized. Some people will be audited, right? So keep in mind the bank is not going to audit you. The bank is receiving the form that's required. It's going to be provided to them by the SBA. And they're going to be the ones to be able to submit this form and it become a grant. If you ever get audited, that's a whole different animal. My understanding is the people who received over $2 million, that may not be a multiple choice question. They're probably going to be audited, and some of you will as well. So make sure you have your ducks in line, no different than preparing a tax return. Again, the forgiven amount is probably going to be taxable. So I think you got to consider that. You got to look at your tax planning. You got to look at your estimated tax payments and what that's going to look like at the end of the year, because you really don't want to get down next year to March 15th and April 15th and you have this extra tax liability, you know, your business has been damaged. Because I look at it this way: I have a CPA firm, and you know, we've had a false sense of security with tax season. But I probably feel like most of small business owners, there's going to be future ramifications of this. This is not just 8 weeks of what's, you know, and it's going to be over with. I mean, I've got clients suffering. I've got people who are not going to want to spend money on tax work and accounting, just as a result of what's going to happen with their business line. So that goes hand in hand with having enough money available to pay the taxes that you received a grant for. Anyway, hopefully this has been really helpful on some things that you should do, what you should expect. And I think at this point, hopefully we have Jevaughn, and he's got his audio and video set up. I think it's going to be really, really important now for him to give you his advice from a banking standpoint, and what the banks are going to expect, and some other elements of importance of communication. So I'm going to turn it over to Jevaughn.
Thank you, Gary. Excellent points. Happy to be here today. Most of you on the phone have already applied and likely have already been funded. But for those who are on the fence, want to just let them know that Amegy Bank is still lending. We expect that funds may be available throughout the end of the week and possibly into next week. Once we work through the initial round of applications, we're seeing very rapid approvals and processing. And to underscore something that Gary said earlier, those who succeeded through this process had or have strong bank relationships. Strong banking relationships mean that you have a banker who you will meet with periodically, take them out for coffee, for lunch, talk about the business, and just have general discussions about the direction or the impact of certain decisions that you're considering that will have on an overall banking relationship and their access to credit facilities. Through this process, we accepted new customers. We thought it was important to fulfill the letter of the law and make the program available, not only to our existing customers, but to new customers. This process was unlike anything we've ever seen, largest loan program in the history of banking, and 2 words I think would probably describe our approach: communication and adaptability. Even while we had a bumpy start to the program, we communicated around the clock and made our customers aware that we are still working on their file. They could rest assured that it's a matter of timing, and we'll be able to get them funded. In the end, we were able to process over 6,600 applications, representing over 150,000 jobs in Texas. And only 5 applications out of those applications were rejected for reasons other than the loan was approved by another lender. So we feel good that we've built a process. The other word that I would use to describe us is adaptability. Sure, there was a bumpy start, but with technology, we became very proficient. And our process really allowed the banker to be accessible to the applicant. Rather than processing everything into a centralized queue, bankers were able to expeditiously consult and with their clients and address issues up front, and that improved the accuracy of our applications. I also think that our accessibility was a reason, is another example of what it means to really bank locally. So let me dive into what I think many of you are concerned about. There was some recent media and governmental criticism of large companies that may have received PPP loans and did not have the financial need to do so. In response to this development, SBA issued a frequently asked question on April 23rd, and it was essentially, they weren't really stating anything new. They were just simply reminding customers that in applying for the loan, they need to certify as to the financial need. So keep in mind that the CARES Act suspended the ordinary requirement for borrowers that they must be able to obtain credit elsewhere. Credit elsewhere is the test that's used in the regular 7A program. That was suspended because the CARES Act made the assumption that all businesses were impacted. So this FAQ was just a reminder that businesses need to act in good faith that their PPP loan request is necessary. And as you've seen recently, loans over $2 million may be subject to review. So what do you do now? Well, we still believe that obtaining capital is important. Whether it's a loan or a grant, you need the liquidity in your hands to adjust to what we think is not only a cyclical impact on the economy, but also structural changes. And as a result of that, many of you may feel impacts to your business that may be delayed. We also think that certain business practices will change. There'll be demand shifts and alternative products that exist in the economy. And that's going to change the way business is done in the future. We don't know exactly how that will play out, but that represents the definition of uncertainty. So what happens if you have a loan? Well, first and foremost, don't default. Don't default on the loan. You can't have your cake and eat it too. You can't have the funds, don't meet the guidelines, and decide not to pay them back. The loan program is governed by a standard promissory note that all financial institutions are using that describe the terms of your loan. And there will be a default judgment issued by the bank and then followed by enforcement by the US Treasury and the Office of the Inspector General. As part of the CARES Act funding, the OIG was funded with over $25 million to enforce compliance. In any large disaster program like this, there's always a large percentage of applicants who receive funds that weren't eligible or received funds as a result of fraud. The OIG will be equipped to review these cases and ensure that the program is used as intended. I also think that early defaults will be scrutinized just as they are in the regular 7A program. So if a company's health was in question prior to the COVID-19 impact, and the COVID-19 impact resulted in their business being dealt a fatal blow, and the funds the PPP funds alone aren't sufficient to keep that business afloat, and the company defaults, banks will file a default application with the SBA for 100% guarantee, but the SBA and the OIG will look at those defaults. Generally speaking, early default is defined as any default occurring within 18 months of the first disbursement of the loan. So you've been given loan documents, and many of you probably executed them using DocuSign. They're very straightforward documents, but I would recommend you reading them and try to adhere to those guidelines. One of the things that's included in the loan terms is a 6-month deferment. So the loan term is 24 months. But the first 6 months, the interest is being paid to the bank by the SBA. So you are not paying that loan. But thereafter, it converts to a monthly payment over 18 months. So depending on your loan size, repaying a loan, 1/18 of a loan each month might represent a significant burden on your company. So my recommendation is, if you have not spent all the cash, as Gary mentioned before, keep it on the company's balance sheet, use it to prepay the loan if you don't need the funds and you can see clear into the future for your business, because there are no prepayment penalties on the loan. The loan can be prepaid at any time. Now, if you have to keep the loan outstanding for 18 months after the deferment ends, then if you have some cash, or if your business is able to start to generate cash flow, ramping up at a slow or accelerated pace, then use the funds to pay the payment on the loan. You will not be penalized. You're accruing interest at only 1%. So those are favorable terms, and terms that we've never before seen in the banking industry. Regarding loan forgiveness, loan forgiveness is not an all or nothing scenario. It's partial forgiveness is available. So don't feel pressure if you haven't spent the money to spend it, because Gary indicated before, you can't prepay and qualify for loan forgiveness. So keep the funds on the books and pay the loan. Now, for many of you who have loan covenants with your lender, there'll be impacts on your liquidity, your cash flow, and your leverage ratios, right? So let's look at each one of them. Well, you would think that the addition of cash will increase your liquidity, but then you have a liability on your books. And so if you have a leverage ratio that could be impacted, it's a short-term liability, therefore it impacts your current ratio. So while you have a current asset and a current liability, there will be an impact to your current ratio. Your cash flow will be impacted when you have to make 1/18 of a principal payment each month. So many of you have a debt service coverage requirement that requires you to maintain at least 1.2 or 1.3 times, you will have an impact to your cash flow once you have to start amortizing that debt. And then also it goes to saying that your leverage ratio will be impacted because you have the addition of a liability, and if you've spent some of that cash, the liability is increased and your net worth is reduced. So there'll be impact. What I would say is bankers understand that this is going to happen, and I think you should discuss these options with your banker. And in many cases, I would suspect that a bank would not call your loan because you had an impact to your covenants from the PPP loan. The important thing there is just communication. Make the necessary adjustments. We'll discuss waivers for a period of time to allow for the impact to be fully realized on the balance sheet. Gary, I'm going to pause there and throw it back over to you.
All right, actually, I think we've got a number of questions. So, Andrew, I know you're going to come on and offer some of those, and we'll try to answer as many as we can get through. I know we've got a ton of them.
Yeah.
All right, Andrew, you on? We had the same challenge. Yep. All right.
There we go. Can you hear me?
Gotcha. Yep.
Great. All right. Well, yeah, we have a lot of questions, which is great. And thank you for participating. And we're going to try to get to as many of these as possible. I think a lot of them probably were already answered. Some are pretty specific. So we're just going to work through them. And if we didn't get to them, we'll probably compile a Q&A document that we're going to distribute since we had quite a few today. I'm going to start off with Dave. He had one that he submitted early, and then also in the chat. If you're a sole proprietor or single member LLC, can you confirm that paying yourself with PPP funds is an appropriate use of the funds? Also, if I pay all the funds to myself, is that automatically an appropriate and forgivable use? And I think a lot of people had that same question about paying yourself a salary, self-employment.
So I can wade into that. The SBA allowed independent contractors and sole props to apply at a later date than employers for reasons that include they had to create specific guidelines for sole props and independent contractors. What we've seen is that they've allowed their net earnings to be used, capped up to $100,000, recognizing that in the absence of paying themselves a salary, the net earnings represent the income to the business owner. So following that train of thought, then income to the business owner would represent their payroll. We're waiting for specific guidelines that addresses loan forgiveness across the board and specifically for sole proprietors. But if you were to interpret the guidelines the way they're currently written, you could conclude that the net earnings could be part of the amount used for, or the amount that you keep for yourself. In other words, the portion that you have not used to pay other eligible expenses could be considered forgivable. If you've used only 15% of the funds to pay other resources, then perhaps you're still left with a 15% portion because 75% of it might be considered earnings to you, and the other 15% may not be forgiven and maybe may qualify for a loan. So the answer to that question, it does depend, and we're waiting for more specific guidelines that will help us calculate that.
Thank you. Another one, we've had a few questions around, so I'm kind of consolidating these, but regarding the management of your funds, tracking it and putting it in a certain type of bank account, when you receive your funds, should you keep it in a separate checking or bank account, pull only from that account, using that as a way of tracking? Do you put it into QuickBooks? Maybe you could elaborate around some management tools there.
I think Gary has a great answer for this.
Yeah, everybody is separate and apart on how organized their books and records are. Obviously, the most clear-cut way would be to obviously have a separate banking account. Whenever payroll comes down, you transfer those funds over. You transfer the funds over when you're going to pay your rent, when you're going to pay your utilities, or you actually pay them out of that particular account. That would be really simple when it comes down to the 8-week period to compile your answer. QuickBooks has classes. You can set up a separate class in QuickBooks and track the expenses associated with the funds received. Or if you're just a very organized company, you're going to be able to isolate that, create an Excel spreadsheet that will then be utilized to fill out the forms, the prescribed form the bank is going to request for you to submit to see what portion is grant, what portion is a loan. One thing I didn't mention when I was talking, this is not an all or nothing. So even though you don't meet some of those tests, part of the loan can be considered a grant, just based on the payroll and the head count. So it's not strict if you don't meet the 75% of the head count at all as a loan, right? Part of it can be a loan, part of it can be a grant. So I just want to make that clear. Jevaughn, you got any points on that?
I think you answered the question, Gary.
Side?
Gary, while we got you, I got
This
another.
is from an organization.
Go ahead.
Okay. No, go ahead.
I was just going to say, Nicole had another question while I've got you regarding taxes, and I think you covered it briefly. It's specifically around IRS Tax Rule 2020-32. Can you explain any implications that they need to prepare for when they receive their PPP funding?
Well, I think you just need to plan on that being a forgiveness, like a forgiveness of debt. I think, what it comes down to is, let's say you're an S corporation and you're at a 39% tax rate. I think you're going to have to think, okay, well, 39% of this is going to go to the government for all practical purposes. And you got to plan for that as you go forth and do a tax plan. I think all small businesses right now should be doing a tax plan. I think they need to try to look at what the cause and effect that COVID-19 has had. They need to look at all the other tax ramifications we discussed a few weeks ago, with the credits associated with FICA taxes and possible carryback features and some of the other tax changes that have come about. But, you just need to figure a portion of this is going to go back to the government in the form of taxes.
Right. Well, thank you. Jevaughn, we got another question from Daniel. It's about kind of checking in with your banker. If you've applied and have been approved by the bank, but you haven't received your funds now for a few weeks, is there any effective actions you can take? Seems like some of the bankers are kind of in the dark just as much as the business owners. So maybe do you have any solutions or tips for troubleshooting?
Sure, this is an area that I've been very active in the last few days. Apparently guidelines or guidance was given to people to apply at multiple institutions, and some institutions were not as communicative as others. So someone's loan could have been approved and is sitting in a queue and it hasn't been addressed. They go to another lender to attempt to apply because they haven't heard anything from their incumbent bank or their original application. And they're informed that their bank was approved, their loan was approved by another lender. The PPP guidelines are clear. You can only have one PPP loan. Therefore, the second lender is unable to cancel the approval that was obtained by the original lender. So you have to follow up with the original lender in earnest to get those funds disbursed to you. What I've done in most cases is I've reached out to the Houston district of the SBA, and they've been very helpful because unlike the banks, they're the only ones that can find out which lender provided the approval to each borrower. So in these several instances that I've been working through in the last few days, we've had applicants with 3 or 4 applications out there, and they don't know which lender to contact, nor have they had much success in communicating with these lenders. So the SBA district office was able to identify which lender actually was first in line to get the approval, and then provide that individual with the name and the contact at that financial institution to discuss the status of their file and to expedite funding. I do not recommend that if you contact these lenders that you say, cancel my application because I want to go with another bank who has been better at communicating with me. I've advised a lot of clients that Amegy would love to have their business, but we do not recommend that they cancel an SBA PPP loan that's already been approved elsewhere. If the loan has been approved elsewhere, take that deal, take that funds, take those funds quickly, and we're happy to continue to talk to you about becoming a new customer if you've enjoyed your experience thus far. But if you try to cancel that application with the original lender, there'll be a time gap before we're able to submit that application. And then it may be a day, and it may be a matter of hours, but in that time gap, you could put yourself at risk of not receiving an approval before funds are exhausted. So in summary, reach out to the Houston district, the Houston SBA district office, ask them to help you identify which lender has approved you, contact that lender directly, and ask for them to expedite your approval and funding.
Thanks, Jevaughn. We discussed this next question a little bit with Mark Winchester last week, but maybe we can elaborate on it and maybe there's a little more color around it. The 25% that's for rent, utilities, mortgage, whatnot, it's very specific just using those words. And going off of Brad's question here, if you're like a cloud-based software business and your key utility cost is AWS services, would that be considered a utility? And I guess really just to snowball on that question, how do you get more details on what is considered to fall under that utility category and that 25% category?
Yeah, the interim final rule that SBA published, and there have been a number of revisions to the interim final rule and frequently asked questions. I would say go directly to the U.S. Small Business Administration's website or treasury.gov and read the interim final rule. It is very specific on what expenses constitute eligible expenses that could be used. Now, I don't know anything about cloud computing, so I can't tell you what if that would qualify for as a utility. But in the traditional sense of the word, utility typically represents electricity, gas, and water. I don't know if internet now becomes a utility. I don't know. This is, again, going back to what was said earlier. You're going to make a self-certification about what you use those funds for, and we're going to submit that to SBA for approval.
Okay, and on the flip side of that, the 75%, a lot of interpretations are out there from reputable sources saying that the PPP loan indicates that if 75% of the loan proceeds are used to pay payroll costs, then none of the loan would be eligible. So I guess if you don't use exactly 75%, does the loan become ineligible? And if you use over 75, is there any absolutes there where you have to meet a certain threshold?
I think Gary did a really good job earlier of explaining that there's going to be two counts, a payroll count and a head count, in determining that percentage. And if you only use 74%, there'll be a partial reduction in the amount of forgiveness. So it's, again, forgiveness is not an all or nothing, right? So it's not a scenario where if you don't hit the 75% threshold, none of it is forgiven. There's a partial reduction in the amount of forgiveness.
All right, thank you, Jevaughn.
It's not an all or nothing. Yeah, it's not all or nothing. And like I mentioned also, Andrew, is, you can give some bonuses. This comes along with planning and having a plan and keeping track of what you're spending. And let's say you're on that 74%, 72%, and you want to give some of your less than $100,000 employees some bonus money to get yourself above the 75%, you've got that ability to do so.
Perfect. Got another question here. It's about employment. So we had an employee that was laid off because of COVID-19, and the individual was part-time, but now they want to bring her back on. Does that change is there a status change that needs to happen to bring them on full-time to meet the PPP requirements?
Well, we talked about the computation, and you may have a hybrid where you have number of hours worked, a number of full-time people, and if she was working 20 hours before and she's working 40 hours now, that actually adds to the headcount computation. If you remember when we discussed that in one of the sections we talked about earlier. So I think it would just be more beneficial if she's going from part-time to full-time from a standpoint of the headcount.
And Jevaughn, are there any timing issues with that? Do they need to bring the employee on now in order for it to be forgiven, or can they wait until June? I guess I'm thinking it probably has to fall within that 8-week time period, but maybe you can elaborate.
Gary made an excellent point that if you bring someone back in June and they haven't been on the payroll for long enough during that 8-week period, it's your discretion about how much, if any, pay you want to provide for sick pay, back pay, lost pay, in order to reinstate their compensation to the level that would allow you to meet that payroll test.
Great. Let's see what else. Do vehicles and delivery count towards equipment?
What was that?
In terms of treatment for the non 75%, for the 25%, do vehicles fall under that? Similar to the internet question that we asked earlier, which I think Jason just elaborated on in the chat.
I didn't hear the question.
Do vehicles count as part of the 25% for exemption?
I think it said that all leases count if the vehicle's a leased vehicle, but that's interesting. If it's a purchased vehicle, I'm not sure it would.
Yeah, like similar to a mortgage payment, a vehicle payment.
Well, I
Yeah.
think once again, Jevaughn answered that earlier from a standpoint of the guidelines when we were talking about utilities. I think drilling down into the guidelines, in which I have not done at this point, but shall, to see exactly what qualifies for that 25%. Jevaughn, you got anything on that?
Nothing more. We're still waiting for guidelines.
Yeah.
Well, great, folks. We're creeping up on the hour. I think a lot of the additional questions have been cleared up, but again, what we plan to do is we're going to go through these again, and we will re-answer them and make sure that, you know, if there's something specific that needs to be answered or addressed, we'll get to it, and we can distribute that with the presentation, the recorded video, the PowerPoint. So I'll thank you very much for all your questions and being very interactive here. It really helps get the conversation flowing and bring out some scenarios that might not normally be covered. So thank you. I'll pass it back over to Jason for some closing remarks.
Yep, thanks again. And again, we have a ton of questions. I appreciate you guys also for being so interactive. We will definitely be following up with you with the presentation, and I would love to chat with you if we can offer any insight to the questions you've got. We'd be happy to do that. If it's something that's specialized, a lot of these are really specific to your situation. And so again, I would just want to encourage you to reach out to Cooper CPA or to Jevaughn at Amegy, and I think that they'll help clarify for your situation. Again, we're going to have another town hall next week and continue on with related topics. So we look forward to seeing you again very soon. If you have thoughts on a topic or questions in the meantime, don't hesitate to reach out. Appreciate it, and hope everyone has a good day. Thank you.
Yeah.
Thank you.
Thanks for the opportunity.